Hey everybody, hope everyone is doing well and had a good day. In this video, I will review the Emini 5-minute chart for Thursday, July 10th, 2025. Just quickly here, I wanted to talk about the daily chart, and I'll talk about the daily chart in a second. I want to look at the 240-minute chart first. The reason for that, this is a micro channel on the daily chart, and I'm looking for a technical pullback to talk about something here. So if you look at the RTH, this is the day session only, regular trading hours. And let's look at what we have here. Just want to be able to zoom out more. I really want to be able to scroll back. Give me just a moment here. There we go. If we look at the market up to this point, this was July 3rd. The market, we're in a trading range. We get a bull breakout, tight bull channel, and it's breaking out to a new high. So this pullback is a major higher low. If we think about correct stop placement, bulls are trailing stops below major higher lows. Break out to a new high, they pull their stop, they trail it to the most recent major higher low. Maybe not quite here, but certainly here. It's a new breakout to a major new high. They can pull their stops to below this major higher low. At this point, market's in a bull trend from the high to the low of the last major higher low. Bulls have the advantage because we're in a tight bull channel. The bulls have probability. So if the market pulls back to this 50% level from the new high to the major higher low, bulls will buy here. They have at least a 60% chance of getting a retest of the highs before running the stops. So I'm mentioning that here because we can see what happened more clearly on the 240-minute chart, at least for right here. Breakout to a new high, pull back to the 50% level, and we bounce and go sideways, and we're starting to get trend resumption, but it's fairly weak. 3 bars down here. My suspicion was that there are disappointed bulls who bought here who might look to sell out of longs on a retest of the highs, which we can talk about that on the daily chart. So we had a high one, but 3 bars down. Inside bar, breakout of an inside bar. Inside bars are trading range bars, triangles. They often get retested fairly quickly after breakouts. So because we got the bull breakout, but we're testing possible resistance by the closed bulls trapped here, may look to take profits at a new high or at the high close, and we may test the high of the inside bar. So for today, expectation probably will test higher, but my suspicion was that there would be sellers, maybe not directly above yesterday's high, but again at these prices, the high close of July 3rd and this swing high. And the high close 63.24 and a quarter. So here's that high close price, expected to be resistance. And then we have the high of yesterday. The high and low of the prior day usually act as support and resistance. And then before we get too far into the 5-minute today, I thought this was interesting on the open to talk about strength of breakouts, strength of signals, and using Ali's 10+2 factors to determine whether it's more likely that a breakout leg or a price leg is a leg in a trading range or a leg in a trend. What we have going into the day, clearly we have a bull channel. We have higher highs and higher lows. Market tried to break out above the bull channel line and reversed, second reversal. Expect a couple of legs sideways to down, and then probably a test of the start of the channel, which could be slightly lower, slightly higher, but we're probably going to test somewhere down here with a couple of legs down. Look at the approach down on bars 6 and 7 and through here. Does this look like a bear leg in a bear trend, or does it look like a leg in a trading range? And if we think about the 10+2 factors, and you can run through them quickly, I recommend if you're new to the 10+2 factors, maybe just write them down on a note card and go through a bunch of examples. Repetition, eventually it will become habitual. The use will become habitual and you'll do it subconsciously. But basically, to run through them quickly, you ask these questions. Are the bars uniform in size? Do most bars close on low? Do we have micro gaps, tick gaps? Does every bar close below the low of the prior bar? Is every high below the prior high? Do we have some opens at or below the prior close? Most bars have no upper tail. Bars have no or only a small lower tail, and there are no dojis and no opposite bars. If we think through that list of everything I just said, maybe the bars are uniform in size here, so we don't take points off, but do most bars close on their low? No, so that's 5% off. We have micro gaps. Maybe there's a micro gap here, but through here, no micro gaps. The bars are all overlapping. Tick gap, maybe a tick gap from 5 to 6. Does every bar close below the low of the prior bar? No, bar 2 does not. Bar 4, bar 5, bar 6, bar 7. These bars are not closing below the low of the prior bar. What about every high below the prior high? No, we have a pullback on bar 4. And then upper tails, lower tails. So we have bars with small bodies, big tails, dojis, opposite bar 3. And when you really think about these factors, there's a lot going against the bear case here, which leads me to believe these are a couple of legs down in a trading range and not the start of a bear trend. And that's expected. You have a spike in channel, bull trend, and you expect the channel to correct for a couple of legs sideways to down. After 3 or 4 legs up, 1, 2, 3, maybe 4 or 5 pushes up here. And we have a couple of legs sideways to down when we're approaching the start of the channel. So this is expected. But at this point, if you think about this price leg down on a higher time frame, it's simply a bear breakout. If we think about the stop location at the major high to the low close, a bear who sells the close of bar 7 has a stop way up here, target way down here. In order to go for 1 times your initial risk, you're risking to up here, your target's down here, and what's your probability? Probably no better than 50-50. And if you're unsure if the probability is 50-50 or maybe even less, and your risk to reward profile is 1-to-1, you cannot take the trade. So it's not a positive trader's equation. So because of that, there's probably support, bears buying back shorts here rather than bears selling here. So then if we think through the opposite, 8, 9, 10, does 8, 9, 10 look like a leg in a trading range, or does it look like a leg in a bull trend? If we take the 10+2 factors again, bars 8 through 10, uniform size bars, most bars close on their high, micro gaps, tick gaps, every bar closes above the high of the prior bar, every low is above the prior low, some opens are at or above the prior close, most bars have no lower tail, bars have no or only a small upper tail, and there are no dojis and no opposite bars. If we run through that list here, we can see bars are closing above the high of the prior bar, fairly uniform in size. Micro gaps, tick gaps, very small lower tails and small upper tails, no dojis and opposite bars. This is a much stronger breakout compared to this. And this is not a very in-depth. It's an example of the 10 plus 2 factors, but that's without even getting into distance and time control, market regime, leg count. But even here, so this is a couple of legs down for the bears, and this is probably leg 1, a reset for the bulls. So if we think about the sell-off down to 7 and the rally up to bar 10, it's fairly clear using the 10 plus 2 factors and simply visually looking that the bull breakout 8, 9, 10 is stronger than the bear breakout 1 through 7. I think it's important to have some kind of systematic way to quantify signal strength for this reason. If for no other reason than to kind of trust what you're seeing. And again, when you take the idea and look at a lot of charts, you start to see that it's legit. Ali has shared with us a systematic way to quantify the strength of a price leg, which is incredibly generous and helpful. So I've gone on about that for long enough. It's going to be a fairly short review, but I wanted to post something today, and I thought this was a good example. So on the open, bull channel, correction for a couple of legs, strong, reversal up, second leg up, likely. We know that there are traders trapped after the reversal and follow through. You call it a 3-bar micro channel. The bull breakout traps traders below. So any pullback is probably going to be minor, and it's very likely that the bulls will get a second leg up, even if we fall below the low of bar 8. And in this context, for stop location, does it make sense to put a stop below bar 8? If you're betting this is the start of a bull trend, it makes sense. You're betting on higher lows and higher highs. But if it is a trading range and you exit at the low of bar 8, you're selling where there's probably more buyers, more support. Look to the left, spike and channel began here. This is more likely a support area, and we just had this strong rally. Chances are if we fall below it, there will be buyers. So that's the problem I have with putting the stop below bar 8. But if you're betting on a bull trend, like I said, it's reasonable. And if you get stopped out, maybe you just look to buy again or react accordingly depending on what happens. So breakout, fairly deep pullback, and then a second leg up. Very strong second leg, similar to the first leg, 8, 9, 10. You use the 10 plus 2 strength factors. This is a very strong breakout, more likely to lead to a measured move up than to fail and run stops below 13 or 12. So, okay to buy for any reason, breaking out above many bars. To the left, the distance is good, price control, time control, uniformity, all good, which resulted in a tight channel, which you could argue began on 16 with the pause bar, or technically with the pullback on bar 18, but either way, high 1, failed trend resumption attempt, second reversal attempt, high 2, led to a breakout and follow through to a new high. Bar 20 is a weak sell signal, tight channel, probably buyers below, and more likely a minor reversal, which resulted in buyers below and a new high, and the channel continued. With a tight channel like this, tight channels are breakouts on higher time frames. I also think it's a good exercise to practice looking at parts of charts on different time frames to better understand the fractal nature of price action and what things look like up and down the different time frames, to develop that trader's imagination. Tight channel, it's a breakout. The odds are the first trendline break will result in a minor reversal and a test of the highs. So 3-bar micro channel down to 33, but the problem with it, a couple problems. First thing, the channel is tight. First reversal probably will be minor. Looks like we're testing near 50% pullback, and also it's approaching the moving average. Been above the moving average for about 20 bars, and traders have been buying above the moving average for that many bars. So the odds are the first test of the EMA will result in buyers and become support. Also in a bullish regime, bullish environment, when the market's always in long, setups for the bears will fail more frequently. So generally speaking, and I hate to say context aside because context is so important. So just for this example, the point I'm trying to make is that yes, 31, 32, 33, bear breakout should get a second leg down, and it did get a second leg sideways, but because it's against a tight bull channel, you have to be cautious if you're trading against the direction of the trend. And once the bears get their second leg sideways to down, which might have been 37, 38, it's probably better to look to trade in the direction of the trend rather than counter trend. Again, this is more likely a minor reversal. It's a trendline break, but it's a trendline break of a tight channel that didn't even break the moving average. This resulted in a triangle, and we're testing the high close on the daily chart. That's this horizontal line. So the expectation was that there would be resistance there. What do you expect at resistance? At resistance, you expect a rally to pause or maybe even reverse. And that's what we had here. The market paused, pulled back, found resistance here again, came close to it, pulled back, tested it again, pulled back. Eventually the bulls got the breakout and followed through. So it's a breakout of a triangle, it's a breakout of that resistance level on the daily chart. And bar 45, kind of similar to, let's see, bar 17 or bar 20. These are bad low 1, low 2 sell setups. Tight channel, bad sell signal. The context is bad for selling. A bad stop order short is a good limit order buy. Buyers below 45 for at least a scalp to a new high. We can see the pause on 48 indicating profit taking, but is 48 a strong sell setup? Is it a good stop order sell? There's no trend line break. It's still a tight channel. It's similar to 25 here, which became a buy the close bar and a breakout to a new high. Now, bar 55, what's happening there? Maybe that's our trend line, best fit, and here's a parallel channel line. I'll just extend that. So, bar 53, testing the bull channel line. And what leg is bar 53? Maybe it's reset here, spike in channel, and evolution into a trading range. New leg 1, pullback. Is this leg 2? Well, we didn't really break out strongly to a new high, and we formed a triangle, breakout mode. So this might be leg 1, breakout mode, leg 2, or maybe this reset the leg count. But for argument's sake, let's say it's leg 1, leg 2, pull back, leg 3, pull back, leg 4. At this point, we're in leg 4, leg 5 territory for the bulls. In the context, we're testing a bull channel line. In a bull channel, you expect breakouts of channel lines to reverse 75% of the time and test the trend line. Only 25% of the time you get the bull breakout and acceleration of the bull trend. So if you're buying up here you're taking the lower probability side of things. 53 might be an exhaustion gap. We don't know at the time if it's exhaustion or a measuring gap, but you're 40 bars into a trend. You're getting the biggest bar in the trend since the initial spike. And it's leg 4 testing the channel line. So there's a lot going against the bull case here. This is more of a profit-taking bar, 53. And the bears got a double top. So first reversal, 54. Second reversal, below 59. Reasonable to exit longs below 59 or 60, and even 54. And from here, the bears got another trendline break. First of all, we got the reversal after the breakout attempt of the channel line and the test of the trend line. But there's a tighter bull trend line that got broken down to bar 66. That's a more significant trend line break, more bars, more distance than this one to 33. More sustained selling. The bears are hoping this becomes a trend line break, retest of the highs, and a lower high major trend reversal. But the bulls have the argument that this could be a double bottom, bull flag, bull trend, trend line break, but now we have a double bottom. Bears got their second leg, 1 pullback, 2. Bull bar closing on its high, 73. Reasonable stop order buy. Reasonable for bears to exit shorts. But then bad follow through, 74, 75. Breakout of the neckline, but weak, and did not close above. So there's the neckline breakout, but it failed. And instead, the bears got more than a measure move down. They got a measure move twice the distance of this trading range. And a big breakout and second leg at the end of the day. This was also testing the start of this channel over here. Spike, and then again spike on a higher time frame, pull back, channel. The start of the channel usually gets tested, which it got tested here. Alright, that's going to do it for today's review. Thanks everybody for watching and listening, and I hope everyone has a good night.